economist warns the U.S. stock bull recession is probably almost 100%. The Bank of America warned U.S. stocks to be falling again. The Fed could raise rates to 6%, and we're still bearish. An economist warns that after S&P hit a technical bull market, that the recent strong stock market rally is unfounded and that the U.S. economy will almost certainly fall into recession. The S&P 500 officially entered a technical bull market on Thursday, rising 20% from its October low. Meanwhile, unemployment data released on the same day showed new claims for unemployment benefits rose to 261,000 last week, the highest level since October 2021. In a report on Friday, Rosenberg said, "This market is still just a short-term momentum game." He highlighted that the disconnect between the stock market milestone and a weak labor market. He questioned whether the current stock valuations are justified, given the increasingly gloomy economic backdrop. You can trust the headlines and you can trust the leading indicators. These indicators suggest that we do have a 99.15% of an official figure-defined decline. If so, this is the first time ever that a fundamental bear market is over before a recession comes in. Rosenberg believes that aggressive federal spending last year may have delayed the recession. He described financial support as a constant gift of strange rabbits. In addition, he suggests that the market sentiment used to be optimistic. The S&P 500 trades at 25 forward PE ratio above the long-term average, and that the index is highly concentrated, and was during the dot-com bubble. He also noted that the low volatility expectations were evidence of extreme investor complacency, and warned that the sentiment was rapidly reaching super bullish levels as FOMO makes a comeback. Rosenberg has been sounding alarm for months. In late April, he predicted a recession by September, with the S&P 500 tumbling 20%, and a credit crunch as banking concerns stifle spending. He also said in February that the U.S. house prices could fall by 15% to 20%. Bank of America warned after the S&P 500 entered a technical bull market that the Fed's measures to counter inflation would boost interest rates and raise unemployment, and that the stock fresh out of the bear market could fall again. A group of strategists led by Michael Harnett wrote in a note Friday, "The Fed has not ended raising rates. We stick to the sell last rate view." He also noted that the stocks will face headwinds as the Fed raises interest rates to fight inflation. Bank of America strategists expect the Fed could eventually raise rates to 6% over the next 12 months, raising the federal funds rate by another 75 to 100 basis points from its current range. That is largely because the Fed remains focused on cutting inflation to its 2% target, and officials have warned that the interest rate could remain high until the end of the year. Inflation below 3% could also bring about 4% or higher unemployment, as higher interest rates tighten financial conditions and weaken the labor market. We're still bearish. We're saying the biggest pain trade over the next 12 months is the federal funds rate at 6%, not 3%. Adding the investors are too bullish on the current rally, with the S&P 500 up 20% from its October lows. That's all I have for today. Thank you for listening. Don't forget to subscribe. See you next episode.